What's up, guys? It is Cashflow Cart. I'm back with another video, and we do a lot of stock analysis videos on this channel. We do portfolio reviews. We've done some reaction type videos, but today I just want to talk. I want to talk about a metric that is oftentimes overlooked by a lot of investors, and I'd say this metric in particular is the reason why I believe that dividend growth investing is the best type of investing for individual investors looking to build wealth and to manage their own money, guys. Let's get into it. And that metric, guys, is yield on cost. Okay, this is very important to understand. I talk about a lot on this channel, being opportunistic, capturing plays when they're undervalued, and building out positions when they're undervalued. And it all connects back to this yield on cost metric, guys. We're going to go over it today. We're going to look at the difference between dividend yield and then our individual yield on cost, because, guys, this yield on cost is going to be on a case-by-case basis. So, no one else's yield on cost on Apple stock is going to be the same as mine. No one else's positions are going to be the same. And that's why with this dividend growth investing game, guys, we can really get to that outperformance. Does that make sense? So let's read, from dividend.com what they say, what they define this term as, guys. Yield on cost is the annual dividend paid by the security divided by the original cost basis of the investment. And the differentiator here between dividend yield versus yield on cost is going to be this right here. The original cost basis, very important to understand. So, rather than yapping about this all day, let's look at an example. I will use one of my own personal positions, guys, and that position is going to be Apple. So I'm on Seeking Alpha right now. I go over to their dividend tab. It's not that hard. The annual forward payout. So the annual dividend Apple is expected to pay in the next calendar year is $1 per share. Apple's dividend yield currently is 0.55% or 55 basis points, guys. And Apple is trading at $184 and change per share. So in order to calculate this dividend yield, I'm sure you guys probably know, we take that $1 divided by that 184.57, and we can do it times 100 so it looks prettier. And there we have it, guys. That 55 basis points, that 0.55%, that is how dividend yield is calculated. Okay? And a lot of people write off kind of this dividend growth investing game because they're always looking at dividend yield. They're not really thinking, 5 years out, 10 years out, bigger picture, how much bang for their buck can they get? And now let's compare that to my own personal yield on cost on Apple. Okay, so we said you take the original cost basis and substitute for the share price. Okay, so same thing here. $1, remember that's the forward dividend, divided by, here you can see my average price on Apple is $117.30. Guys, we use that number in place of that 184, and we can see here, this isn't going to be groundbreaking, but we can already see, as a fairly, I would say, relatively new shareholder, how much higher my yield on cost is on Apple than the actual dividend yield. Okay, do we understand that? And that's why it's so important, I always talk about it, to be opportunistic in this game, guys. If we're just looking at Apple's chart, to identify times when it's potentially undervalued, when it's in a downtrend, maybe when it's going to reverse. And for me right now, I'm not buying Apple at this, 0.55% dividend yield, but I have built out that position and I've locked in, a better yield on cost. Does that make sense, guys? And in order to hopefully drive this point home a little more, we're going to go over to Market Beats Dividend Calculator. I'm sure you guys have probably used this. And we'll compare something like, we'll try to compare what? A treasury bond or a treasury note to kind of my style of investing, which is dividend growth investing, guys. We will start out with 50 grand, okay? And in this first example, we're going to show, what investing in kind of a 10-year treasury would look like, okay? So 10-year treasury, we'll go ahead and get the yield for that, hopefully. Coupon rate, U.S. 10-year treasury note. Coupon rate is 4.375% right now. Maturity, May 15th, 2034. So we will go ahead and use 4.5% as that initial yield. Does that make sense? We're going to start with 50K. And remember, guys, we're modeling kind of a different strategy of investing in, treasury notes. I know we could use a lot of different strategies, but, we're going to keep it pretty simple today because, again, this is a conceptual video. We're going to go no contributions, no taxes. We will do dividend reinvestment. So we will take the proceeds and we will invest them back into that 10-year note. I know it's not a perfect example, but this is what we're going to do, guys. We're going to assume, this yield kind of stays flat. Again, that's not a perfect assumption, but this is an example. This is a learning opportunity, guys. So we're going to go no increases to that dividend payout. Share price appreciation, we're going to keep flat. And then years invested, we'll go ahead and do 15 years. Again, I haven't ran these exact numbers because I wanted it to be very, real and on the spot. And we will go ahead and calculate after 15 years invested, using the 10-year treasury notes, what that looks like. And then we will compare that to dividend growth investing, guys. And I want you to focus on, okay, this is a seemingly pretty good starting yield. Let's go ahead and calculate dividends, guys. Okay, so your portfolio after 15 years using these metrics, a starting principal of 50K and no contributions annually, is going to get you roughly $100,000 portfolio, guys. $96,764. The total return is going to be 93%, and the average annual return 4.5%. That makes sense because that is the yield we put in. And then at this point, your annual dividend income, if you want to start living off these checks, is going to be roughly $4,400. This yield on cost, what that's taking in here is just that starting principal, and it's taking the annual dividend income divided by that starting principal. We can see here illustrated yield on cost, what we've been talking about, guys. And now let's take a look at what it would look like using a dividend growth strategy, guys. We'll start with the same amount. We'll start with $50,000 as the principal. And here, in order to drive this point home, I want to pick a starting yield that is lower, obviously, than this 4.5. Okay? Because a lot of times, critics of kind of this dividend growth investing strategy, they don't take the full story into account. They try to criticize, that initial annual dividend yield. What is the dividend yield right now? They say, I can get 4.5% in treasury notes. Why would I waste my time with dividend investing? Guys, it's BS. We're all tired of it. So today, we're debunking this. Sorry about my voice, guys. I've been having terrible allergies lately for 2 weeks. It's actually been terrible. So we'll start with 50,000 principal. We will start with a security paying an annual forward dividend yield of 3%. Okay? Now there's going to be a few more differences. We're still going to go no contributions to keep it simple. We're still going to, get rid of taxes to keep it simple. And we are going to reinvest. But, as a dividend growth investor, we are, hoping to see that annual dividend amount increase percentage. And, I'd say conservatively, we could probably put in about 8%. I guess that's not super conservative, but actually, we're always being opportunistic. We're trying to find great opportunities. And I don't think we would be too hard pressed right now to find a dividend stock paying 3%, with healthy free cash flow growth and a dividend track record, one that's increased by 8%, at least on a 5-year basis. So we'll go with 8% here, guys. And then share price appreciation. And I will say this. Personally, I kind of struggle sometimes with these examples to kind of wrap my head around them. Because when I think of share price appreciation, typically I expect, in like a 2-year time frame, I'm usually looking for, okay, I want this stock to, return to more of a fair value in terms of its multiples that it has been trading at historically. Okay, so I've been buying Pfizer, as you guys know, but if we take a look at Pfizer, it hasn't had some explosive share price appreciation. Okay, where I make up for that and where I find my share price appreciation is oftentimes going to be it's undervalued. Can it come back to a fair value? And then from there, can we see, a little slower, steadier share price appreciation? That was kind of long-winded, especially when we are just going to assume something similar to the S&P 500, which has been about 10% annually over the past 50 years. We'll go with 8 again. Okay? So, okay. Just to, remind you guys, we had the T-bill example, 50,000 principal. We did a 4.5% starting yield. No increases and no share price appreciation here. 15 years. And then here we are doing the dividend growth example, guys. We did a 3% starting yield, lower than that of the T-bill. Because I know you guys are tired of hearing, why are you wasting your time with dividends? So we're going to show the example. An 8% dividend increase per year, and we went ahead and assumed an 8% share price appreciation. Again, this is not going to be a perfect example, but, enough yapping. Let's get into it. That almost seems unfair. So I'm actually going to take... I didn't want it to be like that much of a skewed result. We'll take this down to... We'll go 6% annual share price appreciation, 7.5% annual dividend yield. And that way, we can still illustrate the point without doing too much. Okay, guys, so as you can see, the T-bill example ended with an ending balance of not even $100,000, $96,764, producing an annual dividend income stream of $4,354, guys. You remember, okay, this initial annual dividend yield was 4.5%, and we ended with $4,300 in income. We go to the dividend growth example. What do we see? This initial dividend yield was only 3%, guys, and we ended with an annual dividend income of $7,045. These two numbers right here are really what I want to compare, guys. If we're trying to build wealth, if we're trying to create passive income, I will say dividend growth investing is the best strategy, okay? It is not rocket science. It's very accessible to the everyday investor. And, with time in this game, you really can develop an edge, and you really can find out what works for you. Okay, so, if you're new in this game, don't be discouraged by people saying, why dividends? Because, guys, we just talked about it. We generated almost $3,000 more in dividend income at the end of this period using this strategy versus just using, I guess, a more conservative strategy of T-bill investing. Guys, that was today's video. I wanted to cover, a pretty basic topic of yield on cost. I hope I did a good job of explaining it, guys. Again, I am Cashflow Cart. I drop videos on Monday at around 6 p.m. And if you are not subscribed, feel free to hit that subscribe button. Hit that like button, guys. I'm going to keep the content coming. And everyone, have a great rest of your day.